Hi, it's Jake here from wealthycorner.com. And index investing can be confusing because there's over 8,000 index ETFs worldwide, according to Blackrock. And not all of these ETFs are index funds, for one. Not all ETF index funds are passive. Not all index funds are diversified. So I'm going to show you how to determine how active or passive an index fund is. In addition, I'm going to show you how to determine how diverse an index fund is so that you can make informed investing decisions based on what's best for you. And to be clear, I'm not saying that an index fund is bad if it has some activity within it and it's a bit more towards the active side. I'm just showing you how to determine what is what. In addition, this breaks down the natural human tendency to label things as black and white. If it's an index fund, it must be passive. Well, not really. And I'm going to show you some of the finer tuning so you can make better decisions. So first up, not all ETFs are index funds. Some ETFs are actively managed funds. These are funds that trade on an exchange, so an exchange traded fund. The ARK Innovation ETF is a great example here. ARK trades on the New York Stock Exchange under the ticker ARKK. If you buy ARKK, your money's pooled with other investors, and then Kathy Wood, who's the fund manager, will hand select individual stocks based on her judgment, so active stock selection. And you, as a fund owner, by virtue of owning the ETF, get to share in the return of those underlying stocks that Kathy Wood has selected. So this is an example of an active ETF, an active exchange traded fund, and it is not an index fund. Let's go down to index ETF. So what's an index ETF? Again, it's a fund that trades on an exchange, and like all index funds, it just holds all the securities that are in the index. And that may make you ask, well, what's an index? And an index is just a basket of stocks, a list of individual stocks. You could also have bond indices, which is a list of bonds, but here I'm just talking about stocks. A good example is the S&P 500 that holds 500 large and profitable U.S. companies, and an S&P 500 index fund holds those same 500 stocks in the same proportion that they're represented in the index. So now you may ask, what makes an index active versus passive? Well, it's not black and white. Like I said, most indices are actually quite passive, but the level of activity is how much buying and selling is actually going on in the fund. And even the most passive index, like I show here, has some level of buying and selling. Maybe a stock is no longer listed on the market, or a new stock comes on the stock market and is listed, and then the index fund would have to buy that stock and get, obviously the one that drops off is no longer part of the fund. So the most passive type of index investing would just be like, hey, let's own all the stocks that trade on the market. That's a total market index fund. Very passive, very little buying and selling. But consider that index is just defined by a set of rules. The S&P 500, the rule, the top 500 companies in size is the main rule. That means that if a company grows and now is part of the top 500, the index fund has to buy that stock and sell one that's no longer in the top 500 stocks. So you can see that based on that rule, now there's some activity that's going on in that S&P 500 index fund, even though it's still quite passive. Here, I show how, the rules for stock inclusion that drive what stocks are in that index, those rules determine the level of diversification of the index and how much activity, how active versus passive that index is. Here's an example for the S&P TSX 60 index, which is tracked by the index fund XIU, which is the oldest index ETF, by the way. Here in Canada and around the world, it's the oldest ETF for indexing. Some of the rules: you must be part of the S&P TSX Composite, which is just the bigger Canadian index, which contains about 236 stocks at the time of writing. And the S&P TSX 60 must have the sector balance representative of the S&P TSX Composite. And you can see that those rules are not necessarily black and white. Someone, if say there's two stocks that are in the top 60, but one really throws off the sector balance, some human must select which stock is going to be made up as part of the index. So it's not entirely passive. If it was 100% clear, cut and dry rules it still wouldn't necessarily be passive because some stocks may no longer meet the criteria of those rules. So they fall off the index, they get replaced with new stocks, which imposes buying and selling. Okay, so I've hammered that point home pretty good. What's the most passive form of index investing? I already talked. It's something like the scissor US Total Market Index, which includes all the stocks in the US market, period. There's some rules about where they're headquartered, making sure the US stocks, and that they're listed on a US exchange. But minimal trading goes on within the fund. And what this means is that as stocks grow and shrink in that basket of stocks, that they're just naturally going to grow and shrink in terms of how much of the fund they make up. And I don't know what YouTube's rules are about embedding a YouTube video in a YouTube video, but this shows the effect quite well, where you can see that billionaire wealth, which is mostly concentrated in stocks, kind of organically is going up and down here. That's essentially what the breakdown of stock size in an index fund looks like, because they're naturally growing and contracting. Overall, there's no buying and selling of those stocks as they grow and contract in value. Pretty cool. So I'll pause that. That shows the effect. And that's exactly why index funds are tax efficient. The most passive index funds are tax efficient. So total market index funds are very tax efficient because the underlying stocks are no longer being bought and sold frequently. So they just grow and contract naturally, and you only pay tax on a gain of a stock when it is sold. So that's the taxable event. So if you hold a total market index fund in a taxable account, so not in a TFSA or a Roth IRA, not in an IRA, 401k, or RRSP, or a health savings account, or a first-time home savings account in Canada, when it's outside of those in a taxable, non-registered account, it's tax efficient relative to something that has lots of underlying buying and selling in the fund. An example of a more active index fund would be Vanguard's US Small Cap Value Index Fund. It tracks all the stocks on the scissor US Small Cap Value Index, and scissor defines the rules for inclusion in that index, which include things like the price to book ratio, the forward price to earnings ratio, the historic price to earnings ratio, the dividend to price ratio, or the dividend yield, which is just synonymous, the price to sales ratio. All of these rules mean that some stocks may grow in their PE ratio and become growth stocks, no longer value stocks. Now they're sold off the index, and the index fund has to sell that stock. Or maybe the dividend ratio reduces to the point where it no longer meets the threshold for the fund's price to dividend ratio. Well, what happens? That stock is sold off by the fund. And you can see that the index, based on the rules, is a bit more active relative to a total market index fund. And that's why VBR, for example, has a turnover rate of 13.1% versus VTI, which is a total market index fund, of only 4%. So as the complexity for rules of inclusion in the index increases, the fund becomes more active. Okay. Now this is interesting. Think about a portfolio manager. A good portfolio manager, to me, based on my experience making decisions in organizations, is they're going to have a set of analytical rules that they use to pick stocks. So good decision making is rules based. And that also negates emotions, because as we see, and you probably know, emotions cause us humans to buy high and sell low. Panic selling or fear of missing out causing us to jump into speculative assets. An index, by definition, is just a set of rules. So what really is the difference between the active investor who has a strong set of rules, a strong methodology for for stock selection rather, and an index? They're really not much different. It's just a set of rules. Of course, the human has judgment capacity relative to the set of rules, but the fund manager also falls victim to human biases, plus you have to pay them a lot more, which imposes higher fund fees. So the indexing approach reduces fees, gets rid of emotion, and maybe it's not as perfect as the active manager at the lateral thinking capacity and the judgment, and maybe some things that cannot be embedded into rules, again back to human judgment, but overall the indexing approach tends to result in much better outcomes. Here is an example of an active fund that uses a rules-based approach, and that's the Vanna Small Cap Value ETF. So it's similar to the stock inclusion rules up here by the scissor US Small Cap Value Index. However, it's not tracking a formal index and has its own rules for stock inclusion to target the value and profitability premiums that are in the family French 5-factor model, which I won't dig into, but those increase exposure to risk, compensated risk, which increases future expected returns relative to a total market index. Okay, that is a good outline of why not all index funds are perfectly passive. Some have quite an active flavor to them, like the small cap value ETF. And as a fund gets more complex as the index gets more complicated in terms of what stocks to include and the rules for stock inclusion, the fund that tracks that index becomes more active, which can reduce tax efficiency. Not all index funds are diverse. Okay, so we talked about the US total market index. There's 4,000 stocks. They're spread across the 11 sectors, as I show here. But now consider IDRV, which tracks the New York Stock Exchange FactSet Global Autonomous Driving and Electric Vehicle Index. So that's an index. There's a set of rules that define what stocks can be included in that index. Companies that manufacture EVs or involved with autonomous driving can be in that index. And an index fund holds all the stocks in the index. So that set of rules that drives the stocks to be included results in near zero sector exposure to 7 of the 11 sectors. Up here, there's 11 sectors. Down here, you see 1, 2, 3, 4 sectors with most of it concentrated in consumer discretionary. What happens when consumer discretionary stocks take a big beating and a downturn? Well, the total market index is going to fare much better because you have 10 other sectors to keep you propped up. Whereas this index fund is going to take a huge hit. It is not diversified. And if you read my content and you understand diversification, you'll see that when you diversify, when investing in stocks, you are reducing risk, but you're not sacrificing future returns. So a total market index fund is going to be less risky. VTI is going to be less risky than IDRV, but VTI is going to have the same future expected returns. You're not going to get better returns by investing in IDRV, even though you take more risk. You're taking extra risk with no additional benefit. So that's how diversification works. The same applies to geographic diversification, which is why I invest in globally diverse total market index funds. All right, so in conclusion, not all index funds are completely passive, but most of them are quite passive. Not all index funds are diverse, and you can see in the index methodology what the rules are to include stocks in the index. In addition, it's interesting to ask that question about the fund manager. What makes that fund manager good should be a good set of rules. And why can that good set of rules not just be used to define a basket of stocks? If the stocks meet those rules, then they're included in the index. If they don't, then they're excluded. So really, a good systematic form of stock selection could be turned into an active index, like the Advanta Small Cap Value Index ETF, resulting in less cost for the investor because you're not paying that fund manager. The rules for stock selection are essentially autonomous now. They've been automated, and it also keeps the emotion out of it with less fees. So that's just something to consider when it comes to investing in active or passive funds, whether they're index based or not. And I hope this kind of takes away those black and white divides and helps you make better investing decisions when you're evaluating your index. That's all I got. Visit the blog, wealthycorner.com. Join the newsletter where I send out posts like this when they're done, and have a great day. Take care.